Let's face it, most of us don't start with $1 million. We start small, with a dream and a willingness to work towards it. The good news? You don't need a fortune to build one. It's about making smart choices with what you have. Imagine turning $5,000 into $1 million. It's not a fantasy, it's a possibility. The key lies in understanding the power of compound interest and investing wisely. It's a journey that requires patience, discipline, and the right knowledge, but the rewards are truly life-changing. Over time, even small contributions can grow exponentially, creating a snowball effect that builds wealth. This isn't about get-rich-quick schemes, it's about harnessing the power of time and consistent growth. It's about taking control of your financial future and creating a legacy of abundance. So, are you ready to embark on this exciting journey? Let's dive in and explore how you can turn your $5,000 into $1 million reality. Compound interest is the secret sauce of investing, the magic that makes your money grow exponentially. It's a powerful concept that can turn modest savings into a significant nest egg over time. Simply put, it's the interest earned on your initial investment plus any accumulated interest. This means that not only does your original investment earn interest, but the interest itself starts to earn interest too. Think of it like a snowball rolling down a hill. It starts small, but as it picks up snow, it grows bigger and bigger, gaining momentum as it goes. The same principle applies to your money. As your investment grows, it starts to generate more and more interest, creating a snowball effect. The longer your money compounds, the more significant the growth. Time is a crucial factor in the compounding process. The earlier you start investing, the more time your money has to grow and compound. Let's say you invest $5,000 with an annual return of 8%. This might seem like a modest return, but over time, it can lead to substantial growth. After the first year, you'll earn $400 in interest. This might not seem like a lot, but it's just the beginning. But here's the exciting part. In year 2, you earn interest on the original $5,000 plus the $400 interest, totaling $5,400. This means your interest for the second year will be based on this new higher amount. This cycle continues, with your money earning interest on interest year after year. Each year, the amount of interest you earn grows because it's calculated on an increasingly larger sum. Over decades, this compounding effect can transform your initial investment into a substantial sum. For example, if you leave your investment untouched for 30 years, the growth can be exponential, far surpassing your initial expectations. The earlier you start, the more time your money has to grow, making compound interest your greatest ally in building wealth. Starting early gives your investments the maximum time to benefit from the compounding effect, turning small, regular contributions into a significant financial cushion for the future. Don't just take my word for it. History is filled with inspiring stories of ordinary people who've turned modest investments into extraordinary wealth through the power of compounding. These stories span across different eras and backgrounds, showing that the principles of wealth building are timeless and universal. From the early 20th century to the modern day, the power of consistent investing and the magic of compound interest have transformed lives in ways that are nothing short of miraculous. Consider the story of Ronald Read, a janitor who amassed an $8 million fortune by the time he passed away at age 92. Ronald's life was a testament to the power of frugality and disciplined investing. Despite his modest income, he managed to save and invest wisely, focusing on blue-chip stocks that provided steady growth over the years. His story is a powerful reminder that you don't need a high-paying job to build significant wealth, you just need a smart strategy and the patience to see it through. His secret: frugality, patience, and consistent investing in blue-chip stocks over decades. Ronald's approach was simple, yet effective. Live below your means, save diligently, and invest in reliable companies. Over time, these small, consistent actions compounded into a fortune that many would envy. His life teaches us that wealth building is not about making big, risky bets, but about making smart, consistent choices over a long period. Then there's Grace Groner, a secretary who invested a $5,000 bonus in Abbott Laboratories stock and held onto it for over 70 years. Grace's story is another shining example of the power of long-term investing. She didn't have a high salary or a background in finance, but she understood the value of patience and the potential of her investment. By holding onto her shares and letting the dividends reinvest, she turned a modest sum into a substantial fortune. By the time she passed away at 100, her investment had ballooned to over $7 million, which she generously donated to charity. Grace's legacy is not just in the wealth she accumulated, but in the impact she made with it. Her story shows that wealth building can have a purpose beyond personal gain. It can be a means to make a significant difference in the world. Her generosity continues to inspire and remind us that the true value of wealth lies in how we use it. These stories aren't just inspiring. They're proof that building wealth isn't about luck or privilege. It's about making informed decisions, staying disciplined, and having the patience to let your investments grow. The principles that Ronald and Grace followed are accessible to anyone willing to learn and apply them. Their lives demonstrate that financial success is within reach for those who are committed to the journey. It's about making a plan, staying the course, and letting the magic of compounding work its wonders. Compounding is often called the eighth wonder of the world for a reason. It allows your money to grow exponentially over time, turning small, regular investments into substantial wealth. The key is to start early, stay consistent, and resist the temptation to make impulsive decisions based on short-term market fluctuations. Remember, the journey to $1 million starts with a single step, and that step is yours to take. Whether you're just starting out or looking to refine your investment strategy, the principles of frugality, patience, and consistent investing can guide you towards financial success. The stories of Ronald Reed and Grace Groner show us that it's never too late to start, and that with the right mindset and approach, anyone can turn thousands into millions. Now that you understand the power of compounding, it's time to explore the different avenues for putting your money to work. Investing can be a powerful tool to grow your wealth over time, but it's important to understand the various strategies available to you. Each strategy comes with its own set of risks and rewards, and knowing these can help you make informed decisions that align with your financial goals. The investment world can seem complex, but it doesn't have to be intimidating. With the right knowledge and resources, you can navigate this landscape with confidence. Whether you're a seasoned investor or just starting out, understanding the basics of different investment strategies is crucial. There are various investment strategies, each with its own risk and reward profile. Some strategies focus on long-term growth, while others aim for short-term gains. It's important to choose a strategy that fits your personal financial situation and goals. Let's break down some of the most common options: stocks, bonds, and index funds. Each of these has unique characteristics and can play a different role in your investment portfolio. Stocks represent ownership in a publicly traded company. When you buy stock, you're essentially buying a small piece of that company. This means you have a claim on part of the company's assets and earnings. When you buy stock, you're essentially buying a small piece of that company. Stocks can be a great way to build wealth over time, especially if the company performs well and its stock price increases. Stocks have the potential for high returns, but also come with higher volatility. This means that while you could see significant gains, you could also experience substantial losses. It's important to be prepared for this kind of fluctuation and to invest in stocks with a long-term perspective. Bonds. Bonds are like loans you give to a government or corporation. In return, they pay you a fixed interest rate over a set period. Bonds are generally considered less risky than stocks but offer more modest returns. In return, they pay you a fixed interest rate over a set period. Bonds can be a good option for those looking for a more stable and predictable income stream. They are often used to balance out the riskier investments in a portfolio. Bonds are generally considered less risky than stocks but offer more modest returns. They can provide a steady income and are often used by investors nearing retirement or those who prefer a more conservative approach. Index funds. Index funds are like baskets of stocks or bonds that track a specific market index, such as the S&P 500. They offer instant diversification and are a popular choice for both beginner and seasoned investors. By investing in an index fund, you can spread your risk across many different companies or bonds, which can help to reduce the impact of any one investment performing poorly. Choosing the right investment strategy depends on your risk tolerance, time horizon, and financial goals. Your risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. Your time horizon is the amount of time you expect to hold an investment before taking the money out. It's crucial to do your research, understand the risks involved, and consider seeking advice from a qualified financial advisor. A well-thought-out investment strategy can help you achieve your financial goals and provide peace of mind as you navigate the complexities of the investment world.